Welcome to this deep dive. Our mission for this session is pretty ambitious, but if you have ever, interacted with the real estate market, it is just incredibly relevant to you.
Very relevant.
Yeah, we are going to uncover exactly how one company is attempting to completely rewire the $5 trillion home buying market and the $2 trillion mortgage origination market.
Which is a massive undertaking.
It is huge. I mean, if you have ever bought a house or even just browsed listings online, you know the traditional process can feel outdated, stressful, and just overwhelmingly complex. So today we are looking at how Rocket Companies is trying to change the architecture of that entire experience.
Right, and to understand how they are pulling this off, we are analyzing a stack of really fresh data. We are looking directly at Rocket Company's fourth quarter and full year 2025 earnings call transcript.
That was the one from February 26, right?
Exactly, February 26, 2026. And we are pairing that with their latest investor presentation, along with some recent financial headlines that cover the broader market reactions to their strategic moves over the past year.
Perfect. So whether you are actively looking to buy a house, or maybe you're a business strategy nerd fascinated by corporate integrations, or someone who just wants to see how artificial intelligence is actually driving measurable revenue.
Not just the usual Silicon Valley hype.
Exactly, not just the hype. If you want to see the real numbers, this deep dive is a gold mine. Okay, let's unpack this. Let's start with the financial performance because, well, the headlines are calling this a blowout quarter.
They really are.
But looking at the calendar, Q4 is usually a dead zone for real estate. I mean, nobody is out house hunting on Thanksgiving or Christmas.
Yeah.
How did they pull off a beat in that environment?
They delivered numbers that caught the market completely off guard. We're talking about Q4 2025 adjusted revenue coming in at $2.44 billion.
Wow.
Yeah, that beat the top end of their own guidance by nearly $200 million.
Wow.
But the profitability metric is what really stands out here. They posted $592 million in adjusted EBITDA for the quarter.
And for anyone not living in financial spreadsheets all day, adjusted EBITDA is basically a measure of raw operating profit. It shows how much cash the core business is generating before you factor in things like taxes, interest, or depreciation.
Right, exactly.
So they are clearing nearly $600 million in core operating profit during literally the slowest season of the year.
Yes, and for the full year 2025, they hit $6.9 billion in adjusted revenue.
Yeah.
Their earnings per share, which is just the portion of a company's profit allocated to each individual share of stock, that came in at 11 cents.
And the consensus was lower than that, right?
The broader market consensus had them pegged at 9 cents, so a solid beat. They also grew their total market share to 5.5%, up from 3.8% the year prior.
That is a big jump in a fragmented market.
It is. But to really understand why these numbers are structurally important, we have to look at the macroeconomic environment surrounding them.
Because the environment has been famously brutal lately. For the last few years, the housing market has been practically frozen. Homeowners who locked in 3% interest rates years ago have been trapped by what people call the golden handcuffs.
Right, they refused to sell because they just didn't want to give up those historically low monthly payments.
Exactly. Who would want to trade a 3% mortgage for an 8% mortgage? Nobody.
But during the fourth quarter of 2025, mortgage rates finally began dropping toward the 6% mark, which is the lowest level we have seen in 3 years. What's fascinating here is a milestone highlighted by Rocket CFO Brian Brown.
Oh, right, the tipping point.
Yes. He noted that the market has finally reached a macro tipping point. For the first time in this entire economic cycle, the cohort of mortgages out there with rates at or above 6% actually exceeds the cohort of mortgages with rates below 3%.
That shifts the entire landscape. For you listening, here is why that specific detail matters so much. It means millions of homeowners are suddenly in the money to refinance. If your current mortgage is at 7.5%, a drop to 6% is a life-changing reduction in your monthly payment. In January of 2026 alone, the population of homeowners who would financially benefit from a rate and term refinance surged to 4.8 million people.
And the underlying data shows it represents over $1 trillion in unpaid principal balance.
Unpaid principal balance, that simply means the actual dollar amount that borrowers still owe on those loans.
Right. And having $1 trillion of that debt suddenly eligible for a better rate, that unlocks an absolute ocean of pent-up demand. A lot of legacy originators, they simply ride the wave of interest rates up and down, they staff up when rates fall, and they literally fire everyone when rates rise.
It's a terrible cycle.
It is. But Rocket has engineered a system that performs across the entire rate cycle. When rates are high, their massive servicing portfolio generates steady, recurring cash flow. When rates drop, that exact same portfolio becomes a captive audience for their origination business.
So they have this captive audience of homeowners paying them every month. But how do they actually keep those people from jumping ship to a local bank or another lender when they decide it's time to refinance?
That brings up this flywheel concept they have been building. It really looks like a masterclass in corporate ecosystem design. They're not just a mortgage company anymore.
Right. They describe themselves as a category of one.
Exactly. They have integrated home search, mortgage origination, loan servicing, title, and closing all into a single loop.
And to put some scale to that ecosystem, looking at the investor presentation, they outline a company with a 40-year operating history, $2 trillion in cumulative origination volume, 23 J.D. Power Awards, and a net client retention rate of 97%.
97% is practically unheard of in financial service.
It really is. To fuel that ecosystem, they went on the offensive last year and acquired Redfin and Mr. Cooper, which is risky because integrating massive public companies usually destroys value. You have clashing corporate cultures, redundant software, mismatched leadership.
Usually, yes. Yet their integration progress is beating every internal target. With Redfin, they achieved their $140 million expense synergy goal 6 months ahead of plan.
And expense synergies are essentially the cost savings a company gets when it combines operations, like realizing you don't need 2 separate HR departments or 2 different cloud hosting providers.
Exactly. And for the Mr. Cooper acquisition, those synergies were originally targeted for the end of 2027. They are now on track to be fully realized by the end of 2026, a full year early.
The cost cutting is one thing, but the technical execution of moving those newly acquired assets into their own ecosystem is wild. Look at what they did with the Mr. Cooper loans.
They migrated 600,000 Mr. Cooper loans onto their unified servicing platform in a single day.
A single day. What usually happens when companies try to move that much data?
It is typically a logistical nightmare. You're moving highly sensitive personal data,
Right.
regulatory compliance histories, escrow accounts, tax records.
Right. If a decimal point shifts during a server migration, a homeowner's property taxes might not get paid, or their insurance lapses.
It is a high-wire act. Executing a migration of 600,000 loans in 24 hours without a system failure is the equivalent of moving the entire population of Boston to a new city in an afternoon and making sure everyone's mail still arrives perfectly.
That is a great analogy, and pulling that off allowed them to immediately overlay their proprietary predictive models across that newly acquired portfolio.
Yes. That predictive modeling powers what they call the recapture engine.
And this concept of recapture is really the financial engine driving their profitability. Let's break down how this works. Rocket's servicing portfolio, which is just the book of loans they manage day-to-day, collecting payments and managing escrows, now sits at 9.5 million clients.
Right.
That generates about $5 billion in recurring annualized cash revenue. But the real magic happens when interest rates drop.
At a typical mortgage company, when a client refinances with a competitor, that original company loses the client and the servicing revenue. The industry average for retaining a client during a refinance, the recapture rate, is only about 25%.
Meaning the average lender is losing 75% of its customers every time the market shifts.
Yes, but Rocket operates at a recapture rate of roughly 80%.
The bottom line implications of that are profound. If you are recapturing 80% of your clients, your customer acquisition cost for that repeat business goes straight to zero.
Zero.
You aren't buying Google Ads or paying for lead generation services because these people are already inside your app. In the fourth quarter, over half of Rocket's total refinance closings came directly from their existing servicing book.
It becomes a self-sustaining loop. They retain the client, originate a new loan, continue servicing the new loan, and keep the client in the ecosystem for the next transaction.
Because these 9.5 million servicing clients are engaging with the platform constantly.
Right, and the system actively monitors their financial status, predicting exactly when a refinance makes financial sense for them.
Here's where it gets really interesting. Let's look at exactly how they are doing that predicting and how they are handling this immense volume of business. We need to talk about their artificial intelligence infrastructure.
This is key. Not AI as a buzzword, but as a mechanism fundamentally changing how humans work.
Exactly. The proof of the AI impact is in the Q4 productivity metrics. They delivered nearly 50 billion in loan volume. That equates to a $200 billion annualized run rate, meaning if they maintain that exact Q4 pace for a full 12 months, they would process $200 billion in loans.
And the last time they originated that much volume was in the first quarter of 2022.
But they matched that 2022 output with roughly half the headcount. They structurally doubled the capacity of every single production team member. Traditionally, if you wanted to get a mortgage, the process was miserable.
Well, absolutely miserable.
You had to hunt down 2 years of W-2s, find a random bank statement from 6 months ago, and fax it all to a banker who was probably out golfing on a Sunday. You just sat around waiting to see if you were approved while someone else made an offer on the house you wanted.
Traditionally, the mortgage industry scales linearly. If you want to process twice as many loans, you have to hire twice as many loan officers and twice as many underwriters to sit at desks and read those faxes.
Right. But Rocket flipped that script through operating leverage. They deeply embedded AI into their proprietary origination and servicing systems. Now, pre-approvals are fully digital. AI handles the heavy lifting.
In minutes, 24 hours a day, a client can get a credit-qualified pre-approval letter entirely from their phone while literally standing in the driveway of the house they want to buy.
Yeah.
Zero human intervention required.
That is incredible. How much data is the system actually processing on its own?
Every single month, Rocket's AI handles 800,000 chats, sends 1.8 million text messages, places 2 million outbound calls, and processes over 5 million documents.
5 million documents.
Yes. It is reading the W-2s, verifying the bank statements, and doing the debt-to-income math instantly. If we connect this to the bigger picture, you realize why mortgage origination is the perfect proving ground for artificial intelligence.
How so?
Mortgages are highly regulated, deterministic, and entirely rules-based. There is no creative ambiguity in a mortgage application. You either meet the Fannie Mae guidelines or you don't. It requires precision and repetition at a massive scale, which is an environment where AI thrives.
Because the software is handling the initial contact, sorting the documents, and doing the qualification math, the human loan officers are freed up to do what technology cannot do. They advise clients, build trust, and structure the actual complex loans.
And this advantage is driving conversion rates 2.5 times higher compared to traditional leads. It allows Rocket to capture over $1 billion in incremental volume every single month that would have otherwise fallen through the cracks.
Simply because a human couldn't respond to an email fast enough.
Exactly. When your technology can anticipate client intent, predict behavior based on credit profiles, and execute the administrative heavy lifting, you build infinite capacity into your pipeline.
But all this technology and scale brings us to a major obstacle that Rocket is trying to solve next. CEO Varun Krishna spent significant time on the earnings call discussing the biggest existential threat to the housing market today, which is the affordability crisis.
It is a vicious two-sided problem right now.
It really is. On the supply side, there is not enough inventory coming to the market because of those golden handcuffs we talked about earlier. People won't list their homes. And on the demand side, millions of Americans desperately want to buy, but the process is highly fragmented and incredibly expensive.
To combat this directly, Rocket announced a brand new three-pillar strategic alliance with Compass, the massive real estate brokerage. This partnership is designed to tackle both the supply and the demand issues simultaneously.
The mechanics of this alliance are fascinating. First, Redfin, which Rocket owns, now becomes the exclusive home search portal for Compass's private exclusives and coming soon listings. Right. For you as a home buyer, in a market where inventory is the biggest hurdle, getting access to homes before they hit the broader market is a huge advantage. Redfin now has unique inventory that literally exists nowhere else online.
And the second piece is Compass itself. With its network of 340,000 real estate agents, Compass becomes Redfin's largest brokerage partner, which drastically expands their distribution footprint.
And third, Rocket Mortgage becomes the official digital mortgage partner for Compass.
The obvious question is, why does this matter to the listener? What is the actual consumer benefit of these giant companies teaming up?
It comes down to pricing, doesn't it?
Yes. Through this deep integration, buyers gain access to preferred pricing. If a buyer uses a Compass or Redfin agent and finances through Rocket Mortgage, they receive significant financial incentives. We are talking about getting 1% off the interest rate for the entire first year of the loan or receiving up to $6,000 back at closing.
Handing a buyer $6,000 to cover closing costs is a massive needle mover for a family trying to scrape together cash to close.
It makes a very real difference.
So what does this all mean? It means Rocket is systematically hunting down and eliminating every point of friction in the home buying journey. They recognize the cultural reality that 50% of renters in America today feel rent-burdened.
But 94% of people say that if money were no object, they would want to own a home.
The American desire for homeownership hasn't changed at all, but the mechanics of achieving it have been broken. Rocket's ecosystem, merging exclusive search inventory, agent distribution, and heavily automated discounted financing, is their blueprint for fixing it.
It really sets the stage for a compelling future. Looking at the outlook for the first quarter of 2026, the momentum is accelerating. Rocket is guiding for adjusted revenue between $2.6 billion and $2.8 billion for Q1.
Strong numbers.
Very strong. They are already seeing a continued surge in January refinances, with those 4.8 million eligible homeowners starting to take action. And despite being the clear market leader, Rocket's market share is currently around 5.5%.
Which shows how fragmented it still is.
Yes, the top 10 players combined hold only 23% of total originations. There is a long runway for growth, and they are built to capture it regardless of which direction the macroeconomic winds blow.
They are essentially building a fortress in an industry known for extreme volatility.
This raises an important question, though, regarding the long-term impact of all this innovation on the industry itself.
That brings us to a final thought for you to mull over after this deep dive. Based on all the sources we have unpacked today, Rocket is aggressively using AI to anticipate when you want to buy, instantly handle your complex paperwork, and pre-approve you digitally in minutes.
Meanwhile, partnerships like the one with Compass are working to lock up exclusive access to the homes themselves.
Exactly. So as AI seamlessly takes over all the complex financial math, the predictive modeling, and the heavy administrative burdens of buying a home, will the traditional role of human real estate agents and loan officers eventually transform entirely into that of an emotional guide or local neighborhood expert? If the platform does the math and finds the house, what is the future value of the human touch in the American dream?
It is a transition that will impact almost everyone at some point in their lives.
Thank you for joining us on this deep dive into the rewiring of the housing market. We will see you next time.